Hey everybody, excuse me, it's Lawrence from financialthing.com here today. What date is it? The 12th of November. Glad to see everybody here. Hope you can hear me okay. Just for some reason today I cannot see the chat in my software here. I'm going to see if I can sort that out, but for now I am running blind, so I can't see what you're saying. Let me have a look here. See if I can find the chat comment button. But here we go. There we go. Found the chat. Welcome, welcome, welcome. Glad everybody's here. We're back to the old format tonight of just kind of general peer-to-peer lending and investing discussion. Let me know if you can hear me okay in the chat. I appreciate everybody being here on this Thursday evening, spending a little time with me nattering on. Please hit that thumbs up button so you won't have to worry about it in the future. Let me move my chair up a little bit. There we go. No real light behind us this time. 1 second. It's not the same without the rear backlight. I'm a little bit discombobulated. But yeah, last week we had a guest on the stream. We had David Bradley Ward from AbleRate. If you haven't watched that, you could look it up in the YouTube channel. It's archived up. They had a really interesting chat with David. I was pretty impressed with his outlook on peer-to-peer lending and the way that he is handling his business. You know, I've been a bit sort of skeptical about the high interest rate peer-to-peer lending companies that pay lenders high returns, but being able to talk to David and I see where he's coming from gave me some extra confidence. But we're going to go ahead and say hi to everybody in the stream like we used to do before we started taking guests. By the way, the next guest is going to be this is the next scheduled guest will be on December the 4th. We'll have the CEO of Cufflink, Narinda, and possibly somebody in between then, if I can get the schedule to work out correctly, somebody that I think you'll be really interested to have on the stream. But I'm not going to announce it just yet because it's not confirmed. But hi everybody, let me know where you're watching from tonight. I am over here in Orlando, Florida. As you know, I took a holiday. When did I go? A couple of weeks ago. Last week, was it? Gosh, time goes. I was in Montana, so we didn't have a stream. Took a week off, but I'm back now. So hi, Steve Manton. Good to see you. Alan Toombs is here in Basingstoke. Welcome, welcome. Annabelle Narin. I hope I pronounced that correctly. Greetings from Spain. Very nice, Annabelle. I can't remember what part of Spain you're in, but I would, if I had to hazard a guess, I would say the south, but let me know where you are. Stephen Green, nice to see you. Welcome. Good to see you back. Paul Bagworth and Kenilworth. Mike Powell is here. Nice to see you, Mike. Stephen Hale sharing with you with the Masters of Golf tonight. Wow, I'm kind of honored. You know, I would have thought the Masters would take precedent over my live stream, but thanks, Stephen. Hi, Paul Stetson. Nice. Good evening to you. Colin Perry in the Peak District. Norman P. in Sussex. Peter Vince in Leatherhead says it's been a lovely autumn day in Surrey today. And yeah, somebody was asking, who was it? Paul Stetson said Yellowstone Park looks nice. Why is Lawrence there? Lawrence was on his holidays. Lawrence does take holidays sometimes. Yeah, so I needed a week. I needed a week off. Aki Chap is here in Accrington, missing his sidekick, Chica Boy. John Day in Nottingham. Dave Dawson. Hi, nice to see you, David. Dawson in Staffordshire. Welcome, welcome. Keith Morrison, Lincoln. Sunny Lincoln, I might add. Probably not, but I like to say that. And Ken Wallace in Dismal Island. But at least you have Guinness. I mean, that's one good thing about Ireland, right? When it rains, you can always grab yourself a Guinness. Hi, Dan, Bob. Welcome in Derbyshire. Wayne Bernard in Kent. And David Alderman from Chilterns. I don't really know what Chilton's is, but it does sound chilly. And Annabelle says she's in Denea, which is the gastronomic center of the region. Okay. Costa Blanca. Yes, I thought probably in the south, right? So Paul says he'd like to see the Ratesetter CEO on here. Yeah, I don't know that he would be too happy about coming on my stream, considering I don't think I've been the kindest to Ratesetter on my review, but we never know. I will actually reach out to Ratesetter and see if I can get somebody from Ratesetter on here. I think that would be super cool. We'll see. Ken says the pubs are shut. No crack to be had. Now you can always go to the shop, right, and buy a Guinness. Maybe it's not the same. Hi, Violet Coley. Welcome. That sounds like a new name for miserable and cold Birmingham. Absolutely. Nice to see you, Violet. So we're going to be talking about peer-to-peer. Let me grab some agua. Yeah. We're going to be talking about peer-to-peer lending this week, some of the news, some of the updates, what's going on with the big platforms and small platforms, and then a little bit about investing short-term versus long-term. If you haven't been following, I've been doing this series on the channel, which is a stock picking experiment, I call it, through Trading 212, which I would say is more of a short-term investing experiment, although I'll probably hold the portfolio, but the plan is to do it for a year and report back weekly, maybe bi-weekly, on how the portfolio is going. So we're going to talk a little bit about short-term investing versus long-term investing and what the different mentalities are behind that, if I have times. Trying to get under an hour today, so we are going to crack right in. Hi, Tony Perkis from Brighton. Nice to see you. And Arthur is here from Belfast. So welcome. Nice to see you, Arthur Atchison. All right, so let's crack right into it. We got quite a bit to get through today. I hadn't done a Loanpad update in a while, and loan book for them has increased a little bit from the last update. We're at £12.5 million, and now the loan book is at 14.1 million. So they seem to be upwards towards the stars. On a secured value of £39.1 million, which has increased a little bit. Average loan to value still stays low-ish at 34%. That really hasn't changed much. And they've increased their lenders since the last time I've looked by almost 100. So that means that people have confidence they're going into Loanpad still. 37 loans on the books now. From my last update was 31, so they've increased by 6. And I did not get a chance to look at the defaults situation. I should probably log in and just take a quick look and see how the defaults are doing. I don't expect to see much change with Loanpad's default situation, because it really hasn't changed. Last time they had one loan in default, and that was really about it. So let's see if they still have one loan. And yeah, they still got one defaulted loan. Looks like really nothing's changed. They got a few overdue loans, but most of them are in the same tranche. So really not much has changed there. They continue to pay daily interest, which I like, and their average loan size has dropped since my last update. Was £421,000. Now down to £382,000, so they got the loan size down, and £19.1 thousand of interest is being serviced by the £40,000 interest coverage fund. I'll be interested to see what happens when that number starts to approach 30 to 35,000. Do they plan on increasing that interest coverage fund or not? I haven't really heard too much about that, but Loanpad seems to be the slow and steady horse in the race. When it comes to peer-to-peer lending, I really think that they're just going to continue to do what they've been doing. And also, by the way, do not forget to join the action groups that are out there on Facebook for the companies that have run into trouble. So we have the Funding Secure Action Group. You go ahead and put those in the chat for you. This is the Funding Secure Action Group on Facebook. We got the Lendy Action Group, who is Mike Powell is one of the representatives with us in the chat today. He always has a lot of good information about Lendy. And also now we have a new Wellesley Action Group for those invested in Wellesley & Co. that seems to be kind of a disaster. So go ahead and join those groups if you're an investor in it, and keep up to date of what's going on with the administrations and with the changes that are going on with those companies. Also, if you want to join the Facebook group for Financial Thing, where we talk about investing, people post things about their investing, and you can join that right there. It's free, obviously. We have about 230 members. If there's anything interesting going on in the peer-to-peer lending world, people, and I tend to post things on there. So yeah, that's good. Okay, let's talk about Ratesetter. What's going on with them? They had a press release that showed they're really not planning on changing these rock bottom interest rates. Let's see if I have the press release. I'm going to pop it up on. Hang on just one second. I think things are pretty much just going to stay, the way they are over there. They're trying to beef up their provision fund. They say their capital coverage ratio remains well above 100% at 154% on the provision fund. And what they are saying is, let me go ahead and pop this up on the screen so you can see it. They say earlier this year, this was in the update, earlier this year we announced an interest reduction in light of the immediate impact of the pandemic outbreak. This was a result of an increased provision for expected future credit losses in March of 2020, including a future forward-looking overlay to reflect the deep uncertainty at the time. Blah, 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 blah. Yeah, and they kind of go through what the coverage ratios are. You can see back in February of 2020 here that the coverage ratio was really high. It was at 250% and sort of dropped, obviously, with what happened with COVID in March, went down to 166%. And now they're trying to bump that back up. So you can see down to its lowest point was at 67% in May 2020. And we're back up to about 154% of coverage, which, you can see the funding amount has sort of remained around that £23 million. I expect these future credit losses to continue. I would think they would go upwards, but that's really remains to be seen how robust the loan book is, how much troubles they have with defaults on unsecured lending. But basically what this means for us as lenders is that the interest rates are going to pretty much remain as they are, which is low. One of the reasons I exited out was they're just not really, the interest rate's just not really worth it. So, the type of risk that you're taking, not to say that you necessarily Ratesetter's risk has really increased a lot, but having said that, and because of the Metro Bank situation, there is that credibility of Metro Bank putting up the security of Metro Bank behind the Ratesetter name. But still, as an investor, you really just have to look at, are the interest rates really worth it? And getting a 1.5% on Access and 2% max on Plus for me is just not really worth it at this point. So that was why I exited. One of the other things too, if you haven't read the review recently that I have on Financial Thing, and one of my readers actually brought this to my attention. I can't remember his name off the top of it, but he emailed me and said that if you have loans that are less than £10, you cannot exit. And what had happened to him is he had a portfolio that he wanted to exit out of, but it was made up of these small loans. So unfortunately, he wasn't able to exit the rest of his money. And I hadn't really tested that out because to be honest, I had only a small amount left in Ratesetter. But I went ahead and tried to release what I had left in there, and I found that that's exactly to be the case, and it's in their terms and conditions too. So if you have a Ratesetter account, you try to get the money out of there, you are going to come up with this issue right here. As you can see, I tried to get out, and it told me that, see at the bottom here, I'll just move it out my way of my head. Let me turn me off here. Some of your contracts have a value of less than £10. We cannot release your investment for these contracts at this time. The remainder of your request should be processed as normal. Now, it may not seem like a big deal, but what I was thinking about was if you're an investor and you have a portfolio of loans that is made up primarily of smaller loans, because you don't really have any control over Ratesetter and how they give you loans. If you had, a several £1,000 portfolio that was made up of these small little tiny loans, unlikely that would happen, but yes, it could happen. You would have a really hard time being able to exit out of a portion of your portfolio because of this problem that you can see here, right down at the bottom. So, and this is in Ratesetter's terms and conditions. I don't really understand why it is the way it is. I don't know why you wouldn't be able to exit a loan contract that is less than £10. That doesn't make any sense at all to me. So it is something you want to be aware of if you're thinking of investing in Ratesetter, or you're already in Ratesetter and you are trying to exit. You may see a portion of your portfolio stuck in purgatory. And there's pretty much, unless Ratesetter changes those terms and conditions, there is no other way to, there is no other way to get out. I was just reading a comment there about my voice. So yeah, very, very interesting. I don't think that those Ratesetter interest rates are going to go anywhere for the next, certainly not the end of the year. Possibly next year, first quarter, who knows, depends what happens with coronavirus. Not looking particularly good at the moment, but with talk of the vaccine, who knows. Next up, LendingWorks. If you're a LendingWorks investor, you would have gotten this email notification about negative interest rates. And this is the first time that we've seen a peer-to-peer company talk about negative interest rates. We've heard about possible negative interest rates through banks, but LendingWorks was the one to drop the hammer of the negative interest rates on peer-to-peer lenders. I was surprised. Not going to lie, I was very, very surprised that they decided to do that. Probably just a way for them to cover themselves, because COVID is obviously creating some havoc within peer-to-peer lending. Let's go ahead. What they did is they put out a credit risk performance update. And, even if you're not a lender through LendingWorks, you do need to know that these things are possible that can happen within an investment vehicle, whether it's LendingWorks or any of the other peer-to-peer companies can change their direction and stance on, interest rates at any time. Don't think for a second that these interest rates, the peer-to-peer lending companies, or, as you've seen it within banks, are going to be the same. They're not going to remain constant. So LendingWorks has really been the first to drop this bomb. So I'm going to show you a little bit about this credit performance update. And if you want to read it, you could go to LendingWorks' blog. It's absolutely public information. So basically they're talking about, right here, at the end of September 2020, approximately 90% of customers exiting their deferral period have resumed their regular monthly payments, which are positive and in line with the industry average. However, approximately 2% of our loan book was still on a payment deferral. Hence, there remains uncertainty on those customers' ability to resume their regular monthly payments. Slightly more concerning down here, furthermore, we have observed performance deterioration within the group of customers that started to miss their loan repayments but did not engage with our collections team and did not request a permanent payment deferral. Now, those are the people that basically have probably thrown their hands up in the air on their loans and probably are not planning to repay. And that goes on to say, we believe many of these customers will go on to default on their loans. It seems pretty obvious. And here we go. As a result of our latest assessment of expected unrealized bad debt for the remaining term of active loans has increased by 30%. We will be required to adjust lender rates further using the existing lender rate adjustment mechanism, resulting in a period of negative interest rates to divert more funding to the shield to cover the loan defaults that we expect to occur within the coming months. Whilst a period of negative interest rates is needed, the expected annual returns received by every retail investor over the lifetime of their investment is expected to remain positive. Despite the COVID-19 crisis, we still expect no capital losses. To account for the impact of COVID-19, the period of negative interest rate will be phased, being more severe for 3 months, then easing after that. Expected annual retail investor returns have decreased compared to our Q2 2020 update. Average returns in the past from 2014 to 2019 have reduced from 4.6 to 4.2% for growth investments and 3.8 to 3.6% for flexible. So it looks like you're going to see 2020 expected returns drop from 4.2 to 3.6% on growth and 3.0 to 2.6% for flexible. And if we look at their statistic page here, you can see down here they have a lifetime default rate. You can see the expected annual loss is starting to increase. Again, not really too surprising considering what's going on with COVID. I mean, let's be honest, unsecured lending is probably going to be one of the first things to go. If you're somebody that's borrowing money and you run into trouble and the only thing that's going to get hurt is your credit history and your credit report, you're probably going to let your loan go. You can see right here, 2020 is the red graph here at the bottom. It's a little bit funky the way this thing here, but you can see the graph starting to increase up, sort of flatten off, but you're going to see these rates start to increase, and you can see 2018 was already up to 9.1%. So LendingWorks, I don't think is faring as good as they probably would have liked to have been faring at this point, but we're going to see what happens with them. Not panicking yet, but they're still paying money. You can still get your money out every month. We'll just see what happens. They have been taken over by, I want to pronounce this right, Invitra or Capital, which is a capital, I think, an investment company that's taken them over. So they do have some backing behind that. So I'm not particularly concerned, but definitely not the greatest news. Talk about negative interest rates. But again, if you're a peer-to-peer lender, what you want to be focused on right now is capital preservation. So if you're getting, minus 1% return and it's preserving your capital, look, it's not the end of the world and it's not going to last forever. We're talking about what? On £1,000, very, very small amount of interest, £10 in the minus over a year at minus 1%. But I'd rather have a negative interest rate for a short period to save the capital than I would try to be earning 2 or 3% and the capital to be in jeopardy. Learned that lesson the hard way with some of the other peer-to-peer companies that have run into trouble. Go ahead and if you have any questions or comments, leave them down below, put them in the chat. I will go ahead and answer them as when I'm done with my sort of little news report here. Let's see what else. So we've been running for 26 minutes. Again, if you can hit that thumbs up, it helps me with the YouTube algorithm search. I really appreciate that if you're enjoying the stream. So Assets Capital, yeah, they've put out we got an update from Stuart Law. He always seems to be very positive. At the end of the day, look, we don't know what's going on behind closed doors. I've always said that SME lending, you're going to have some bumps in the road due to COVID, because businesses that have borrowed money some of them are gonna run into trouble. It's just the way it is. So don't be surprised if you see those loans on Assets Capital start to rise in the late payments and the default status. It's just the way it is. The good thing is they've got a good team and they do know how to handle those situations. And plus, the one thing I do like about Assets Capital is a lot of the loans are amortizing, so it means that as capital is paid back, the loan balances start to reduce down, the loan to value start to go down, and the longer the loan has been paid off on an amortizing loan, it means that your risk is actually reducing. So what that means is if a loan goes into default recovery, somebody's borrowed 100 grand, but the capital left is 50 grand. Now you have a lot less to recover than if you were trying to recover 100 grand that hasn't amortized down at all and it's just been completely interest only. So I'm going to try to get Stuart Law on here. He's the CEO of Assets Capital as one of the guests. Just waiting to get the schedule sorted out with him. So he is somebody that I'm really interested in talking to. Let's see. We had a Cufflink update. They said we may have taken longer to repay some capital and interest in some instances, and we definitely have seen that. What's happening with Cufflink and other peer-to-peer lending companies is they're extending loans for people that are obviously having some issues. It doesn't mean the loans are necessarily in trouble, but Cufflink's doing what they can for their borrowers. They certainly want to work with the borrowers. They don't want to start defaulting on them. So they have gone ahead and extended quite a few loans. No problem there. As again, like I said, in December, first week, we're going to have the CEO of Cufflink on here as a guest. But they said, we really appreciate your patience while we've worked with our borrowers to secure repayment of their loans, as you would expect. COVID-19 has set people back, and we have needed to agree some reterms on loans to enable the full repayment. There will no doubt be some further reterms still to come, but please bear with us. We would rather reterm these loans to allow our borrowers a little extra time to repay the loan than to have to recover the loans, which could take much longer than a short-term reterm. Through these challenging times, we're still proud to be able to say that no investor has lost their capital with Cufflink, with a little star up on the top. Says that's not guaranteed. And I believe that under these difficult circumstances, we are in a good position with our lending, safeguarding investors' capital, maximizing returns, and mitigating risks. We are still very much open for business during this lockdown, so please contact us if you'd like. So yeah, pretty positive, upbeat. It's nice that the communication's there. So Cufflink is still going along as good. We had a Zopa CEO update this year. Over the last week or couple of weeks. I put it in my inbox just so I could check it out. They had a pretty big update. It's a key takeaway. 70% of borrowers who opted for a payment freeze or reduced payment plan have now resumed contractual payments. Thus, our modeling suggests, although there will be an uptick in defaults in 2020, we expect over 97% of investors to see positive returns over the next 12 months, providing they haven't made a large loan sale recently. After this period of positive, albeit lower projected returns, things should normalize and trend back upwards towards the returns you're used to seeing from Zopa. Given the unprecedented turbulence the UK has faced this year, we're pleased that our underwriting and risk management approach has set us up to weather this difficult period. I was looking at the statistics on the Zopa. Let me see if I can pull it up here. Returns are going to be pretty dismal if you're a Zopa investor. Hopefully you can see this, but if you want to look at this too, you can log into your account. They have a update, but you do have to be logged in. But this just shows what investors can expect in the short term. You can see here the 2020 estimates were 3.7 to 3.9% for Zopa Core, and the estimate now for 2021 has dropped all the way from 1.5% to 2.1%. Let me turn off the old phone. So you're going to see definitely a drop off in 2021 returns. You can see Zopa Plus going from 4.8 here in the blue to 5.0 in the estimate for 2020, all the way down to 1.8% to 2.6% estimated return for 2021. This is a reason, again, I started to exit out of Zopa last year. Even before COVID hit, I just didn't think that those returns were really worth what the risk that we were taking as an investor. Zopa has the big name behind it, but at the end of the day, again, if I'm getting paid 1.5%, 1.8, 2% for Zopa Plus, it's just really not worth it. So I saw that kind of happening back in 2019, the end when I started to exit. I think it was 2019, maybe early 2020. But you can see here, this is what's going on with Zopa. They have the Metro Bank situation. And I think, again, I've always said that I believe that Zopa will eventually phase out its peer-to-peer lending of retail. I just don't think long-term that's what the company is going to focus on. They're going to be doing lending through their bank credit line, through Metro, actually not a credit line, but Metro is going to be lending its customer deposits into Zopa's loans. And I think you'll see that Zopa will eventually get rid of retail peer-to-peer lending. And these rates are really starting to drop. So you can see, that's what's going on. Let's see. We had Property Partner has been one of these companies that has really taken a bit of a beating from COVID through. And for anybody that doesn't know what Property Partner does, they basically sell shares in properties that have been purchased. So, for instance, I'll take a building with a bunch of flats in it, buy it, and sell shares in that building. You can buy shares, and then you would, in theory, receive a dividend payment that would come from rental amounts and rental income and revenue. They also have dabbled in student housing, and they've dabbled in development loans, which through a secondary lender and a second charges, which I wouldn't touch myself. I don't tend to touch anything second charge, especially development lending. But I'll give you an example of something, an example of what's going on with Property Partner. So what they do every 5 years is 5 years after the property's purchased, it goes up to vote for the shareholders, and they decide, do the shareholders want to keep the property or do they want to sell it? And 33% of one of the properties in London, which I was invested through, 33% of shareholders wanted to sell their shares. And what Property Partner then does is take those shares, put them on the secondary market on Property Partner, and hopefully investors will buy those shares and buy out those people that wanted to sell the property. What happened, however, with this property in London is they weren't able to sell those 33% shares, and therefore they're forced to ignore what the other 69.333 recurring percent of shareholders wanted to do, and they have to go ahead and put the property up for sale anyways. So it was pretty interesting that they decided to do that, and it's in their terms and conditions. I personally thought that property, the shares would be able to be resold in the secondary market, but alas, that did not happen. So at this point, the property will be vacated from the tenants who will move out at the end of the year, and the property will go up for sale. I don't know how much they're going to be able to sell the property for. It'll be really interesting because of what's going on with COVID. Let me see if I can log in and show you this property too. It's I really find this kind of fascinating because we just don't know what property values are like at the moment because of what's going on in COVID. But just give me a second. I'm going to pull this up, share my screen with you, show you the property. Let me see here. Okay, you have to be hush hush. I'm not even sure if I'm supposed to be showing you this, but I'm a bit of a rule breaker. So there we go. This is the property in Whitechapel, London, and you can see here the valuation is £530,000. It's a 2-bedroom flat, and the way that Property Partner works, you can see it has a share price valuation. This is basically what the market will pay, and it's been dropping. Blah 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 blah. You can see the fluctuation where it used to be. Apparently, it's kind of dipped down. What Property Partner has started to do, which is I think is a really good thing, is it's being more transparent with the finances of the particular deal. You can see here the share valuation information. What each property has is supposed to have a cash buffer in case that property needs something doing to it or runs into issues. And this one is minus £4,076. You can see the rental income breakdown too on the property. It's currently at an annual deficit of £8,444. And I think, not every property is in deficit. There's definitely a few. I think 2/3 of the portfolio right now is in deficit, if I remember correctly, 1/3 not being in deficit. It's interesting because I thought, this Property Partner system was very intriguing to me when I first got into peer-to-peer lending and investing. So I thought, yeah, it makes sense, own shares in properties, get your piece of a dividend payment out of it, and then in the future the property gets sold for more than what it was paid for. Unfortunately, COVID has put the kibosh on a lot of these properties that are run into problems with vacancies. So we're going to see what happens with this property here. I'll show you the photos. It's kind of cool. It's a nice place if anybody wants to buy it. It comes with this beautiful mattress. Nothing else, just the mattress. So yeah, it'll be interesting to see out of the valuation what they're able to get for that. I don't think they'll be able to sell it until next year, but that's what's going on with Property Partner. And one of the deals that came across its 5-year threshold for renewal or for sale. Let's see what else we have going on. And again, leave your comments. We'll answer any questions at the end. I don't think I talked about this the last time, but there's going to be this Seedrs and Crowdcube merger. If anybody's a investor in Seedrs, or if you're not, basically, you're buying shares in startup companies. Highly speculative, I'll say. Highly speculative. The way Seedrs used to work was it became more of a invest in a startup company and hope that that company does well and gets bought out. There's been some companies on there that have had really successful runs as businesses and have been bought out or even floated on the stock market. But what this Seedrs Crowdcube merger is now showing, Seedrs really became a trading platform for shares within startup companies. And it's really a unique idea. I didn't really understand, what people saw in investing in startup companies, but now I understand. For a startup company, it makes a lot of sense because these companies can't float on the stock market. They're too small. They can come to a company like Seedrs and float their shares on Seedrs, have speculative investors come in and buy shares and hopefully get a bump on the uptick. The speculative side comes in the fact that you could buy shares in company A at £1 and they could fall to 40p. Demand and supply shares are going to be based on what people are willing to pay for them. So there is that risk involved. But with the Seedrs and Crowdcube merger, you're going to see a very high level of liquidity within shares for startups. Seedrs has a pretty expensive trade fee if you're thinking about getting into this. If you buy or sell shares on Seedrs, you're going to be paying a 1.5% fee, which is hefty. Seedrs also charges companies a pretty hefty fee too, so 7.5% company exit fee. So that means if a company floats an IPO, like a share offering on the stock market, and they move shares from private holdings to publicly traded, they have to pay a 7.5% exit fee. And that's hefty. I mean, that's good revenue. It seems like Seedrs, from a fundamental standpoint, is making some good revenues on those exit fees and also those trading fees. So I don't know how long those trading fees will remain to be that high. But I thought it was interesting on what's going on with that merger. And let's talk about long-term investing versus short-term. Again, if you haven't seen my trading 212 portfolio experiment that I'm doing, I'm basically just stock picking, and I put £5,500 into a stock picking portfolio, bought a bunch of shares to see if I could beat the indexes. And basically, I'm trying to see if I can beat my trusty Vanguard US Index Equity Tracker, which I think over the long term I probably won't be able to do that. Last time I looked and checked the portfolio, we're doing pretty well. We're just under 10% up on it. But the US Index Tracker was making a run towards leveling out those numbers. When I first started, the Equity Tracker was kind of really lagging behind. But now that gap has started to decrease, and why that happens is because I'm picking stocks out. Some of the stocks that I pick are not going to do as well as other stocks. For instance, I got one stock on there, it's 28% in the red at the moment. A couple of other ones that are in the negative. And then I got other stocks that are plus 30%. This is what happens when you try to pick stocks. You're going to pick some winners, and you're going to pick some losers, and what's going to happen over the time is it's really all going to balance out. And with the timing mistakes and emotional decisions that you can make, especially short-term investing, if you're trying to flip in and out of stocks and shares, you're going to make emotional decisions that are not going to be optimal. A good example of this is I bought this company called Fastly, which works in the cloud with TikTok. TikTok is decreasing their business with Fastly, which means Fastly's revenues are going to decrease, and Fastly's stock price started going like that. Had a huge run up. I think I was up 35% on the share, and then it went down to minus 20. So we had this huge swing. And in my brain, my emotions are going, you need to get rid of this share. When I start seeing it in the red, minus 15%, minus 20%, and I see other shares, for instance, Lloyd's Bank is up, I think, at the 25 or 30% range in the portfolio. And I'm thinking, well, the smart thing to do would be to flip from the minus 20% share Fastly into a share that's in the positive at Lloyd's Bank. Problem is, the timing is probably not going to be correct. And this happened to be true because I think a couple of days ago I almost looked at exiting out of Fastly, and then the next day it goes up 7%. So that would have been a 7% mistiming, emotional decision on my part on that share. Short-term investing through stocks and shares is very much dependent on when you get into the market, and not only within stocks but also index trackers, gold, Even Bitcoin, by the way, if you look, I've been telling you for a while, Bitcoin is probably something you're going to want to have a hold of, just even if it's a small amount. Bitcoin's rallying up to about 16,000 US dollars today. So we're almost getting back to those levels of Bitcoin where we were when it was at the $19,000, $20,000 point. Anyway, that's a different conversation. But again, short-term investing, highly, highly market timing dependent. You go ahead and show you what I'm talking about with this. So if you look at, for instance, this is the gold charts for going back to 2002. And obviously we've seen this big run up on gold, right? The problem is this: when you're trying to time markets, if you're in this gold buying for a very long-term period of time, you started back in 2002 and you just kept buying, you just kept putting your monthly allocation into gold, there would be no decision, right? Because you're thinking a very long-term outlook. So you're here over 20 years, you would have done pretty well. However, if you're a short-term, somebody that's flipping in and out of gold investments right now, and you happen to buy in, say, here 25th of April 2011 at 1,526 US dollars, you would have seen this run up here and you'd be excited, but then you would have seen this drop. So if we'd have paid $1,526 in 25th of April, and we had held that goal all the way, let's see here if I can flip that back. Hang on one second. Okay. If we'd have held that goal through the years and we've seen it drop back here to 1,300, right down here to 1,100, and that's 5 years later, you'd be feeling pretty sick about buying in for 1,500 in April of 2011 and going, seeing absolutely no returns over 4 years. Now, the question is, if you're a short-term investor, do you have the willpower to hold on to that investment while you're watching this big drop here, say from 1774 all the way down to the rock bottom 1061 in 2015. So a lot of people, myself included, we don't have that willpower as a short-term investor to be able to hang on to something and seeing that it's not done anything for a period of 5 years. I mean, in fact, if you look here at 1,526, you'd have to go all the way. Let me just move this out of the way. You'd have to go all the way back to 2019 of December to recover to that point of where you were here in April of 2011. So that is almost a decade of zero returns in your gold. Okay. Now, if you're a long-term investor, somebody that's been investing since 2002, you would have just kept on buying and buying and buying and buying and buying. And you wouldn't have really cared what happened in these drops because you have a very long-term thought process. So this is the problem with trying to move in and out of investment short-term. It's the same with if you look at the index, the US index tracker, heavily market dependent. If you'd have bought in at 566 pounds on this Vanguard index tracker, and you're trying to be a short-term investor who's moving in and out of the markets, you watch your investment go down here into the bottom, right, at 413 pounds from 566 pounds. Do you have that emotional ability to be able to hang on through those lows? Now, me being an investor in these index trackers since for the last 4 or 5, I think I'm coming up on 6 years now, I don't really care what happens to the prices in the short term. So I started investing in 2015. So if we look at, let's see here. Let me go ahead and show you what the prices were historically back then. 2015 in January 1st. Okay, I'm going to go right to the end here. These prices were £271 and 23 pence for this US Vanguard index tracker. And I just kept on buying and buying and buying as a long-term investor. And I'm getting those dips. I'm buying through the highs and the lows. And I really don't care if the market starts to drop. For instance, here, £291 down to 285 fluctuations. You can see the price. And then we get to the November of 2020. And now we are, I need to go to page 1, at October, £551, £52. You can see how much the price has really increased because I had that mentality of being a long-term investor. Number one, with the index tracker, I don't have to worry about trying to pick things. I'm not trying to worry about what stocks I have to choose because I have one index tracker that's in a basket. It's a basket of several thousand stocks. I don't have to worry about trying to flip in and out of this fund. There is no decision to make. I pick an index tracker that I like, whether it's a global or a US, which I would prefer, and definitely US. I don't mind the global either. But there's nothing for me to decide. I don't have to look at, this stock's 20% in the red. I need to get out of that. My gold hasn't done anything for 9 years. I'm going to move from gold into cash or gold into an index fund. I got no decision to make here. I'm just going to sit and I'm just going to buy through the highs and the lows. That's a really important thing to know about when you're a long-term investor. You just don't have to worry about, those short-term fluctuations. So as you can see, if going back to January 2015, this fund has gone from £271 to £593 without me having to worry about choosing anything or stock trading. And that's a very, very important thing to know. Picking out stocks is very, very difficult. If you have a lot of time to research fundamentals, you're very experienced in doing that kind of thing. You may have a better shot at picking out the right stocks. I'll give you an example. My brother-in-law owned Lloyd's Bank shares when it was 75p, and he'd been sitting on these things. He's like, they're not going anywhere. They're just not doing anything. Then we see Lloyd's Bank shares drop down to 24p, and those people who are holding them at 75p, probably didn't have any idea this Lloyd's Bank share was going to go down to 25p, 24p. I bought in at 24p because I thought, Lloyd's is, surely it can't go lower than that. It's a fundamental business of a bank. And then the stock price goes up a little bit. But it's very, very difficult to know. And I think even nowadays, the way the stock market is running, fundamentals are becoming less important. And fundamentals of companies are not powering the stock market like it used to. You can see now that there's companies with huge price to earnings ratios that are completely out of whack. Look at Tesla. It's in the 400s in the price to earnings. Apple's in, I think, 30 or 35. And yet you might see Tesla stock continue to increase because fundamentals are not powering those stock prices as much as they used to, 10 years ago. And the reason for that is, one of the reasons is a lot of young people and people that have access to buying shares now didn't used to have that, 10 years ago. Now they can buy these apps like Trading 212. They can get these apps like Robinhood and they can buy fractional shares. And you're just seeing all this money pouring into the markets because there is nowhere else to put your money. What are you going to do? Put it in a bank at 0.5%? If you're investing for retirement, you pretty much have two options. You could buy property and do buy-to-lets, or you can put it in the stock market. So money's going in. It's powering the stock prices up because there is no alternative. TINA, I talk about that a lot. TINA, there is no alternative. And people are, investing in things that they probably normally wouldn't, and is pushing the stock prices up a lot. So I think it's important to be a long-term investor and just think about what is your goal long-term, what's your plan, and really stick by that. Again, market timing, very difficult. It's very easy to buy in at the top and to see nothing happen. If you look at these gold charts for almost a decade, nothing happening on the gold chart if you bought in up here at the top. So yeah, pay attention to that, and keep that in mind if you're thinking about selling your shares or whatnot. I'd advise just hang on to things at the moment and think on a very long term. Unless a couple of things to be said on that. If you're in close to retirement age, obviously equities are a lot more risky than fixed income products or even cash. So just something to keep in mind. Anyway, I've been waffling on for almost an hour today. It wasn't the plan. If you please again hit that thumbs up if you've enjoyed the stream. I'm going to go through the comments here and see if you have anything that you need help with this week. Paul Stetson says, "I'd like to see the Ratesetter CEO on here." Me too, Paul. Maybe email Ratesetter everybody and say, "Hey, we want you to come on Lawrence's peer-to-peer lending live stream on Financial Thing and come be on there with us." I will try to get him for sure. We'll see. Mike Powell says, "Isn't the Ratesetter CEO just the Metro Bank CEO?" Yeah, I don't know. When I say CEO, maybe I'll try to get somebody in charge. Maybe that's the right word over at Ratesetter. I don't care whether it's the CEO. I used to have a pretty good relationship with the CIO. Yeah, but he's gone now. That was Mario. We'll see. Norman P says, "I would like to hear from Assets Capital." Definitely working on that, Norman. We'll hope to get Stuart Law on here. Annabelle wants to see LendingWorks' boss on here. Yeah, I've never had a good LendingWorks has been difficult. They've never really opened their doors to me. I've tried to get into their offices several times when I've been in London, but they've not been particularly good when it comes to that. But I'll reach out to them and see if we can get it. Steve says he would like to hear from LendingWorks also. Totally understand. Let's see. John Day says, "Has anybody tried Able Rate since last week?" Yeah, I'd be curious. Has anybody tried Able Rate? If you have, let me know. Steven says he's trying Able Rate to see how it goes. Yeah, I think you'll be okay. Don't put too much money into any one peer-to-peer lending company. By the way, diversify. It's very important. No matter how comfortable you feel with a peer-to-peer lending company, you just learn from the past of what's happened with companies that have run into trouble. One of the most important things I was told by a CEO of a peer-to-peer lending company, he said, any one of them can have problems, even ours. So nothing's guaranteed. Tony Perkis says, NS and I are reducing in a few days, interest in near zero. Any ideas for safe, above inflation, accessible investment? There's 55K to move around. The only safe, really safe place you can put your money is in savings accounts. I would look at premium bonds too. I think on premium bonds, going to be about a 1% tax-free deal. So I used to really be against premium bonds. Actually, I told my mother a few years ago she had to sell them all because the returns were so bad. But now premium bonds, it looks like, because of what's happening with interest rates, really not a bad place to put your cash. Yeah, there isn't really too many alternatives, unfortunately, Tony, at the moment. Just some savings accounts are offering, maybe lucky if you can get 0.75%. A lot of the accounts you got to jump through hoops to get decent percentages, like put in £150 a month, and they limit you to how much you can put in. I just can't be bothered with it. So I would say premium bonds. You can put in 50K in premium bonds, and it's liquid. So, but I think they may start shutting those things off too with the premium bonds and probably reducing the interest rates on those. But It's looking about the best option at the moment. Hi, Gail. Nice to see you. Welcome to the stream, Gail Leach. Let us know where you're talking from. Chica Boy's here. Nice to see you, Chica Boy. Were you late this week? Dave Dawson says, I suspect defaults will improve with Ratesetter as if Metro banks are taking on new loans. Only the people who aren't defaulting will be left. Yeah, I suspect that will be the case too, but you do have unsecured lending still happening in Ratesetter, so it really will depend on how much of a percentage of the portfolio that Ratesetter still continues to do secured lending. But we'll see. Yeah, Paul says, what do you think will happen to Ratesetter loans in the long term? I think you'll probably be seeing pretty much, much of the same going on. But I don't know. It's hard to tell. It's hard to predict. I don't have I do have a crystal ball, but it doesn't work. It's useless. I think that what will happen in the future with Ratesetter in general is they'll get out of retail peer-to-peer lending. And they'll go the same way as Zopa. But, the loan book is going to be highly dependent on what happens with COVID, when the vaccine comes, whether the people that are borrowing money get themselves back on their feet. I mean, there's so many unknowns. We just don't know how long this COVID situation is going to hang on for, so it's very hard to say. I definitely don't see the interest rates increasing for lenders' returns anytime soon. So we'll see. Chica Boy says, most of this I don't understand. I just like his calming, soft voice. Thank you, Chica Boy. I appreciate that. Gail said, Bondora behaved like that. They made it impossible for you to withdraw your money. At one point, they were only allowing you to withdraw $5 and charging you a $1 withdrawal fee. I think you were referring to what's going on with Ratesetter and the £10 limit. Peter Vince says, I seem to remember that the minimum investment for Ratesetter is £10. Hence, if you're trying to exit your loan needs to be sold on, but people can't buy small ones. Yep. That is true. I think they do have a £10 minimum. I just don't understand how they can't repackage loans in some way to let people exit out of those £10 loans. I'm sure they can if they want to. Annabelle says, I'm very worried about my money in lending works. Well, I wouldn't panic yet, Annabelle. I mean, there's pretty much nothing you can do at the moment. There is no way to get out of lending works. You can't exit. So just hang in there, Annabelle, and we'll see what happens. I'm not particularly panicking about lending works at the moment, but because they were taken over, they got some money behind them. Norman says you can withdraw interest on repaid loans in lending works. I'm getting £500 a month. That's true. Yeah, make sure you go in and just withdraw your repaid loans and interest out of your account. You don't want it to be sitting in there. Mike says, how do you have negative interest rates? Isn't that just a way of obscuring a fee? Yeah, it's funny. For a peer-to-peer lending company, you really don't have negative interest rates because negative interest rates come from banking systems where banks are having to pay central banks to store money, which LendingWorks doesn't have. And you're right, it's just a way to reduce basically reduce the returns that our lender's going, so you could put more money into the Shield fund, which is their provision fund. So you could look at it like a fee. Yeah, that's exactly right. Yep, Norman P, you're right. It is just a way for them to throw more money at the Shield. Steven said, did the S&P 500 jump up this week? I looked at the markets today, and over the week it is down 1.39%. So technically no, but we did see a rise on November 9th. It jumped up and then on the 10th dropped back down again. So yeah, we're having a bit of a negative day on the markets. So Dave says your share portfolio should be reduced to 5 shares maximum, I believe, to make a good chance of beating the market. You're probably right, Dave. The problem is, what 5 shares? I have this want to hang on to the shares that are doing badly right now, and I don't know which ones. I'm probably going to reduce it down. I did sell off some things this week, which will be in the update. I think the portfolio, when I looked earlier, was up about 9%. So it's, again, a lot of emotional decision making on this share portfolio. Like, what do I really want to hang on to? What do I think is going to win in the next year? We'll see. Paul says, due to COVID unemployment this year, would I be better putting my spare cash into investments or topping up my national insurance contributions to ensure I get a full state pension in retirement? Paul, there's some questions that have to be asked. For instance, how old are you? Are you close to retirement or not? Personally, I would not put money into national insurance at my age. I'm 47 years old, because I think the investments will outperform in the long run. So I'm not a big believer in government pensions. I think that just you're better off doing it yourself. That's my personal opinion. Some people don't believe that. For instance, in the USA, they have this thing called Social Security, which I think is a complete disaster. It's basically you pay into it through your taxes, and at the end of it, when you retire, you can choose to retire earlier or later, and that has an effect on how much money you're paid every month, depending on how much you put in over your lifetime. Problem with Social Security is that you don't get any returns, so you could pay into this thing for 50 years of your life, and the government's basically holding your money for you for 50 years of your lifetime and not giving you any returns. So it's a losing proposition. Because if you took that money yourself and invested it over 50 years, your returns would be very, very nice, and you'd have a lot more than you started with. So that's why I'm not big into government pensions. So for me, I'm always going to go to invest the money than putting it into any type of national insurance contribution. Paul Bagworth says, any collateral news? No, Paul, I have not seen any collateral news, but next week I will look into it this week and see if I can dig up some collateral news for you. David Dawson says, normally in a portfolio, 1 in 5 of your shares actually make you the most of your profit. Yeah, I've seen one of the shares that I had trade desk was up 75%. Complete fluke. You're right. Yeah, Mike Powell says assets capital discount rate on the QAA account to exit just above 3% now. I talked about that right at the beginning when this happened, when they introduced this being able to exit. The discount rates were silly. They were 8, 9, 10%. I saw them at, and I said if you just have some patience, I think those rates will start to come down after a while. I didn't think it'd be this quickly. I thought that would take probably till the end, more towards the end of the year, but now you can exit out with a better discount rate. So, of course, that depends on demand and supply. That can change. David Alderman says, isn't charging a negative interest rate the same as losing your capital? Yeah, pretty much. That's true. David said, David Dawson, I think Cufflink had trouble on their admin side, a touch with working from home. I had cash released after 6 days once rather than suggested max of 5 days. Sure, it was due to admin. Yeah, I haven't taken any money out, so I don't know. I'll just go through the rest of these and then we're probably going to wrap it up. We've been on here for a 1 hour and 12 minutes, so thank you for everybody that stuck by. It was a long waffle today. AccuChap has noticed that NIO shares have shot up by 11% today. In your face, Tesla. Yeah, you saw times when Tesla was whacking up about 11%. Highly speculative. And you got to get in at the right time. Brian says, 7-Eleven, Honved, capital gains tax will hit buy-to-let landlords as they sell off. I've got a few in my portfolio and will need to speak to an accountant next year. Absolutely. Don't do anything strange with the taxes. You end up in jail. Dave said, one reason I prefer shares to rental properties is you could sell a percentage of your shares not easy with a property. Absolutely, property is very illiquid. It's not easy to get out if you need to get out quickly. Colin Perry said, the recent PayPal announcement supporting Bitcoin helped it push above 10,000, currently 12,000 and climbing. Yeah, 12,000 pounds. One thing you need to know if you're buying Bitcoin through PayPal, I don't see it as actually real Bitcoin because you cannot move it out of PayPal. No, Bitcoin, if it's real Bitcoin, can be moved. So how they're doing that? Yeah, I just buy Bitcoin through places like Coinbase versus PayPal. Scott Peacock says, Loanpad offer 4 to 6% to lenders, whereas Crowd Property blend 8 to 10%, and all relate to property development refurbishment. Is it a given Loanpad is lower risk in your view? Yeah, Loanpad doesn't offer 6%. They offer a max of around 4%. It's absolutely, I believe, to be low risk just because of the way that Loanpad structures their loan borrowing. Think about this, and this is the main reason. You've got Loanpad is in first position over their over their borrowers, which puts them in a very, very strong position, and their loan to values are extremely low. They have an average of 34% loan to value in first position. So you're paying for that lower risk, and you're going to pay for that in the form of lower returns. Whereas Crowd Property and Blend, you are taking on properties that have much higher loan to value percentages, and they're different types of loans too. So, no loan is different, but I definitely would put Loanpad in a lower risk category than Crowd Property. I think it's good to have both. John Day says Rolls Rights issue 34p at 90p today. Any thoughts about the future? Quality company beneath those airplanes flying again? I have no idea, John. Rolls-Royce never really been an investment that I've ever looked at. I think it's speculative, but it's a quality company, like you say, but with the airplanes being grounded, not all of them, but a lot of airplanes are grounded at the moment, what are going to be the sales of Rolls-Royce's engines? Who knows? I think if I was looking at shares, especially in English shares, or I don't tend to buy too many UK companies, but I'd be looking at company with good fundamentals, or even things like biotech. I think biotech is going to do really well over the next few years. But companies with good fundamentals, things like banks. Chica Boy says Loanpad have their own skin in the game. Yeah, technically not true, Chica Boy. Just to let you know, Loanpad does not have skin in the game, but their borrowers do. So make sure that's an important thing to understand. Yep, Dave says Loanpad is a lot more liquid. So that's never a guarantee, by the way, but at the moment you can withdraw out of Loanpad within less than a day. So you're just not going to get that in any other peer-to-peer company. So you're going to pay for that. Here's my white teeth, Cheek Boy. They're not that white. Aki Chap says, did you get a chance to look at the new peer-to-peer company you mentioned a while back? Yeah, I'm still doing research on that. I don't want to present something just yet, but it's going to be, I know I've been saying this for a while. It'll be in the next 2 weeks that I'll tell you about it. Lots of good conversations today in the chat. I appreciate all of your input. Thanks for stopping by, Annabelle. We'll see you next time. Yeah, somebody's asking whether world trackers or US trackers. I bought back in July, I bought a world tracker just to compare. At the same time, I bought a US index tracker, and they're not really performing too much differently. I think maybe the world tracker was 0.5% lower, but the thing about the world trackers is they usually have quite heavy weight in the US. If you look at the Fidelity one, for instance, or the Vanguard one. But it's hard to say, we just don't know what's going to happen with any of these countries and what way they're going, whether China is going to be really in the positive this year or not. Anything can happen. I mean, look at COVID, right? Completely upset the world. So I just go off of past history. And if I've looked at world trackers versus the US has really performed better than the world tracker. But that's not to say that history, it doesn't guarantee anything in the future. So yeah, but I don't dislike the world tracker, by the way. Dan Barber says, any word on how the Growth Street resolution is going? No, things have been quiet. Have not heard anything at all. Thanks for joining us, David Dawson. Nice to see you. Yeah, Annabelle says she's worried about lending works going into the negative, but you're talking about the thing about lending works is they haven't said how much in the negative they're going to go. I presume it to be a small amount, but I guess they could go 10 minus 10% negative rates, right, and then really mess things up. Who knows? Who knows? We have no idea. Adios, Annabelle. Have a great evening over in Spain. David says, did you try options yet? I think it has a higher chance of success on your share account. Yes, I've been doing my options experiment for the last couple of months, and I'm going to make a video about that soon. I'm still really learning my way around how the whole system works, and I definitely think there's some pretty high risk involved, but I've been doing it the least risky way possible, and I've been doing pretty good. I think maybe 2 or 3% in the plus every month. So we'll see. When I have some more experience with it, then I'll show how you could use options to possibly get better returns. Problem with options in the UK, you got to buy 1,000 shares to sell a covered call contract, so you got to have some capital behind you to do it safely. I mean, you could do naked options, which is based on margin, but I wouldn't recommend it. It's gambling. All right, John, nice to see you. Thanks for hanging out this long. I'm going to wrap it up. We've been on way too long. Thanks again for everybody joining the stream. I hope you enjoyed it this week. Please hit the thumbs up before you go. Subscribe to the YouTube channel. Don't forget and join the Facebook group. You can search for it on Facebook. Just search Financial Thing on Facebook and you'll see the group. And we will look forward to seeing you next week, Thursday at 7:30 p.m. UK time. And have a great week. Be safe out there. I know you're in lockdown at the moment in the UK, so be safe and have a great week. It's great to see everybody. Thanks for spending the time. Take care. Bye.